There are 7 Social Security mistakes that quietly cost seniors thousands of dollars, and most people make at least one of them without ever knowing. Here is the hard truth about Social Security. It is one of the largest financial decisions you will ever make, and yet almost no one explains the rules to you before you make it. You get one shot at most of these choices, and a single wrong move can permanently shrink your monthly check for the rest of your life. Not for a year. For the rest of your life. I have spent years reading through the fine print of how these benefits actually work, the dense rules most people never have the patience to wade through. And the same painful pattern shows up again and again. Good, hardworking people lose thousands of dollars, not because they did anything reckless, but simply because no one ever told them what to watch out for. So in this video, I am going to walk you through 7 of the most expensive Social Security mistakes, one at a time. For each one I will tell you who it affects, roughly how much it can cost you, and the exact first step to avoid it or fix it. Number 6 is the one almost everyone overlooks, and it can cost you the most of all, so make sure you stay with me until the end. One quick but important note before we begin. This is general information, not financial, tax, or legal advice. Social Security rules, income limits, and dollar amounts change every single year, and the right move depends entirely on your own situation. So always confirm the details with the Social Security Administration, or with a licensed professional, before you make a decision. With that said, let us start with the most common mistake of all, the one that more people regret than any other. Mistake number 1. Claiming your benefits too early. The very first month you are allowed to claim Social Security is age 62. And for a lot of people, the temptation is almost overwhelming. The money is finally available, you have paid into the system your entire working life, and it feels only natural to start collecting the moment you can. But here is what most people do not fully understand when they sign up. If you claim before what is called your full retirement age, your monthly benefit is reduced, and that reduction is permanent. It does not snap back to normal later. It does not catch up when you turn 70. The smaller check you lock in at 62 is, in most cases, the check you will live with for the rest of your life, and it follows you all the way through retirement. Claiming at 62 can permanently cut your benefit by around 30%. Depending on the year you were born, claiming at 62 instead of waiting can shrink your monthly benefit by roughly 30%. Think about what that really means. If your full benefit would have been $2,000 a month, claiming early could drop it to somewhere around $1,400. That gap repeats every single month, for as long as you live. Now, I want to be fair, because claiming early is not automatically the wrong choice for everyone. If you are in poor health, if you genuinely need the income right now to cover your basic bills, or if you have no other way to make ends meet, then taking benefits early can be exactly the right decision for your life. There is no shame in that at all. The mistake is not claiming early on purpose, with your eyes open. The mistake is claiming early by accident, simply because you did not realize the reduction was permanent, or because no one ever showed you what waiting even a couple of extra years could have done for your check. This should be a decision, not a default. So here is the part that turns this from a regret into an opportunity. Before you claim anything, create your free account at the official Social Security website, ssa.gov. There you can see your own estimated benefit at every possible age, your real numbers, not a guess. Look at the difference between claiming early, claiming at your full retirement age, and waiting. Then make the choice on purpose, based on your health, your savings, and your plan, not on impulse. Mistake number 2. Not understanding your full retirement age. This second mistake is closely tied to the first, but it trips up even people who think they already understand the system. Your full retirement age is the age at which you qualify for 100% of the benefit you have earned. It is not 62, and for most people today, it is not 65 either, even though that old number is stuck in so many people's minds. For nearly everyone retiring now, full retirement age is 66 and some number of months, climbing up to 67 for those born in 1960 or later. So if you are still picturing 65 as the magic number, the way it was for your parents or grandparents, you may be planning your entire retirement around a date that simply does not apply to you anymore. But here is the part that most people never hear at all. Your benefit does not stop growing once you hit full retirement age. If you delay claiming past that point, your monthly benefit actually keeps increasing, all the way until you turn 70. Every year you wait adds a meaningful boost, and those increases are guaranteed by the rules of the program itself. Waiting past full retirement age can add about 8% to your benefit every year, up to age 70. These are called delayed retirement credits, and they add roughly 8% to your benefit for each full year you wait beyond your full retirement age. Think about that for a moment. There is almost nowhere else in the entire financial world where you can earn a guaranteed increase like that, simply for being patient. For someone in good health, with other income to live on in the meantime, waiting can be one of the smartest moves available. Let me paint a simple picture. Imagine two people with the exact same work history and the exact same earned benefit. One claims the moment they turn 62. The other waits until 70. The one who waited can end up with a monthly check that is dramatically larger, sometimes 70% higher or more, for the rest of their life. Same career, same earnings, a very different retirement, decided almost entirely by timing. Now again, waiting all the way to 70 is not the right answer for everyone. It depends on your health, your family history, your other savings, and whether you can comfortably cover your expenses in those in-between years. The point is simply this. You cannot make a wise choice about when to claim if you do not even know what your full retirement age is, or what waiting would actually be worth to you. So your action step for this one is short, but it is powerful. Find out your exact full retirement age, which is based on your birth year, and you can see it right inside that same Social Security account. Then look at what your benefit would be at full retirement age, and at 70. Once you see those three numbers side by side, claiming early, claiming on time, and waiting, the decision becomes far clearer than any rule of thumb a stranger could give you. Mistake number 3. Triggering the earnings test while you keep working. Here is a situation that catches an enormous number of people completely off guard. Let us say you decide to claim Social Security early, but you are still working, maybe part-time, maybe full-time, because you enjoy it or because you still need the paycheck. What many people do not realize is that there is a rule called the earnings test, and it can temporarily reduce the benefits you just started collecting. Here is how it works in plain language. If you are below your full retirement age for the entire year, and you earn more than a certain annual limit from working, Social Security withholds part of your benefit. The rule is roughly $1 held back for every $2 you earn above that limit. So you can find yourself in the strange position of claiming your benefit, but barely seeing any of it actually arrive. Earn above the yearly limit before full retirement age, and benefits are withheld. The exact dollar limit changes every year, so I am not going to quote you a number that will be out of date by the time you watch this. What matters is the principle. There is a threshold, and once your work income climbs above it, the early benefits you are collecting start getting clawed back, at least temporarily, while you remain under full retirement age. Now there is some genuinely good news buried inside this rule, and it is something a lot of people get scared by without understanding. The money withheld under the earnings test is not gone forever. Once you reach your full retirement age, Social Security recalculates your benefit and gives you credit for the months that were withheld. So your monthly check is adjusted upward to make up for it over time. And here is the other crucial detail. Once you actually reach full retirement age, the earnings test disappears completely. From that point on, you can work and earn as much as you possibly want, with no reduction to your Social Security benefit at all. So this trap only applies in those earlier years, when you are claiming early and still working at the same time. So how do you keep this from quietly eating your check? If you are planning to keep working, be very careful about claiming Social Security early at the same time. Look up the current year's earnings limit on the Social Security website before you decide, and run the numbers honestly. For many people who are still working a solid income, it makes far more sense to simply wait until full retirement age to claim, when the earnings test no longer applies and your benefit is larger anyway. Mistake number 4. Leaving spousal benefits on the table. This next mistake is one that married couples make constantly, and it can cost a household a serious amount of money over a lifetime. Social Security is not just about your own personal work record. If you are married, you may be entitled to a benefit based on your spouse's record instead, and for many people that spousal benefit is actually larger than the one they earned on their own. Here is the basic idea. A spouse can generally receive a benefit worth up to half of the higher earner's full retirement age benefit. So if one person in a marriage earned much more over their career, the lower earning spouse may be able to claim a benefit based on that larger record, rather than being stuck with only their own smaller amount. For many couples, that single fact changes everything. A spouse can receive up to half of the higher earner's full benefit. This matters enormously for couples where one person stayed home to raise children, or worked for many years in a job that did not pay into Social Security, or simply earned far less over their lifetime. That lower earning spouse is not left with nothing. The system is designed so they can lean on the higher earner's record, but only if the household actually understands the option and claims it correctly. And the timing of who claims when can get genuinely complex, because the two benefits interact. In many households, the smartest strategy is for the higher earner to delay their own benefit as long as possible, growing it with those delayed credits we talked about, while the household structures the rest of its income around that plan. Get this coordination right, and a couple can add up tens of thousands of dollars over a long retirement. So here is what every married couple should do before either of you claims. Do not look at your two benefits in isolation, as if they have nothing to do with each other. Look at them together, as one household decision. Check both of your records on the Social Security website, and seriously consider sitting down with a professional who can map out the best claiming order for the two of you. The difference between a coordinated plan and two separate guesses can be staggering. Mistake number 5. Overlooking survivor and divorced spouse benefits. This one is deeply important, and it is also one of the most heartbreaking when people miss it, because they tend to miss it during the hardest moments of their lives. Social Security includes powerful protections for widows, for widowers, and even for people who are divorced. And yet a shocking number of people who qualify never claim what they are fully entitled to receive. Let us start with survivor benefits. When one spouse passes away, the surviving spouse may be able to step up to the larger of the two benefits the couple had been receiving. In other words, the survivor generally keeps the higher of the two checks, not both, but the larger one. For many widows and widowers, understanding this rule is the difference between real financial stability and a frightening drop in income. A surviving spouse may keep the larger of the two benefits. This is also exactly why the earlier point about delaying matters so much for couples. When the higher earner waits and grows their benefit, they are not only helping themselves. They are protecting their spouse, because that larger benefit is the one that may carry on as a survivor benefit after they are gone. Patience by one spouse can quietly become a lifelong cushion for the other. Now here is the one that almost no one talks about. If you are divorced, you may still be able to claim a benefit based on your ex-spouse's work record. In general, if your marriage lasted at least 10 years, and you meet the other requirements, you can potentially claim on their record. And here is the part that surprises people. Claiming on your ex's record does not reduce their benefit, and in most cases they are never even notified. Let me say that again, because so many people quietly suffer in silence over this. If you were married for at least 10 years and are now divorced, you may be leaving money on the table that is rightfully available to you, money that takes absolutely nothing away from your former spouse. Pride or awkward feelings keep far too many people from even asking the question. So whether you have lost a spouse or gone through a divorce, here is what you must not skip. If your spouse has passed away, contact Social Security directly to ask about survivor benefits, and ask specifically about your options for when and how to claim, because the timing strategy can be different from a regular retirement benefit. And if you are divorced after a marriage of 10 years or longer, call and ask the simple question. Do I qualify for a benefit on my former spouse's record? That one phone call can change your entire financial picture. Mistake number 6. Never checking your earnings record for errors. Now we have reached number 6, the one I told you almost everybody overlooks, and the one that can quietly cost you the most without you ever suspecting a thing. Here is the uncomfortable truth. Your entire Social Security benefit is calculated from your lifetime earnings record, the history of how much you earned in every working year of your life. And that record is not always correct. Think about how many jobs you have held over the decades. Think about every employer who reported your wages, every name change, every move, every year a payroll department had to get your information exactly right. If even a few of those years were reported incorrectly, or an employer failed to report your earnings at all, then the benefit being calculated for you could be based on numbers that are simply too low. A wrong earnings record means a smaller check for the rest of your life. And because your benefit is built directly on those earnings, an error in your record flows straight through into a smaller monthly check, for the rest of your life. The truly painful part is that almost no one ever catches it, because almost no one ever bothers to look. They simply trust that the numbers must be right, and they accept whatever benefit they are handed. Imagine working a solid, well-paying year early in your career, only to discover that the income from that year was never recorded under your name. Quietly, year after year, your calculated benefit has been just a little lower than it should have been. Over a long retirement, an unnoticed gap like that can add up to thousands of dollars that were always rightfully yours. Here is the very good news. This is completely within your power to check, and you do not need to wait until you are about to retire to do it. In fact, the earlier you look, the better, because correcting an old error is far easier when you can still track down a pay stub, an old tax return, or a W-2 form from that year as proof. So this is the single easiest and most valuable thing you can do today. Log into your free account at the Social Security website and pull up your earnings record. Then go through it year by year, and compare it against your own memory and your old tax documents. If you find a year that looks wrong, or a year of work that is missing entirely, contact Social Security to get it corrected, and bring your proof. This one habit can protect every check you will ever receive. Mistake number 7. Ignoring the tax that eats your benefit. And that brings us to the 7th and final mistake, one that catches people completely by surprise, often in their very first year of collecting. Here it is. The federal government can tax the very Social Security benefits that you spent your entire working life paying into. A lot of people are genuinely shocked when they see it appear on their tax return for the first time. But here is the good news, and it is the same theme you have heard throughout this entire video. With a little understanding, this is something you can actually control. Whether your benefits get taxed, and how much, comes down to a single number. The tax rules call it your combined income, and once you understand it, you gain real power over your own tax bill in retirement. Your combined income is roughly your adjusted gross income, plus any non-taxable interest you earned, plus 1/2 of your Social Security benefits, all added together. That total is the number the tax rules look at to decide how much, if any, of your benefit becomes taxable. It is not your benefit alone, and it is not your other income alone. It is the combination that matters. Below $25,000 single, or $32,000 for a couple, benefits are generally not taxed. If that combined income sits below roughly $25,000 as a single filer, or $32,000 as a married couple filing jointly, your benefits are generally not taxed at all. As your income climbs above those lines, a portion becomes taxable, rising up to a maximum of 85% of your benefit. Notice that even at the very top, it is never 100% of your check. Now here is where this becomes something you can plan around, instead of something that just happens to you. Because the tax depends on your combined income, the timing of how you pull money from your other accounts matters enormously. A large withdrawal from a traditional retirement account in the wrong year can push you over one of those lines and make more of your benefit taxable. Picture a single retiree whose combined income lands just under that $25,000 line. They generally owe no federal tax on their benefits. But nudge that same income a few $1,000s higher with one big withdrawal, and suddenly a portion of the benefit becomes taxable. Same person, same benefit, a very different tax bill, decided almost entirely by the timing of their other income. So here is how you keep more of the benefit you already earned. A few smart moves, like spreading withdrawals across several years, or drawing strategically from Roth accounts that do not count the same way, can legally keep more of your Social Security in your own pocket. And remember, many states do not tax Social Security at all. This is exactly the kind of thing worth talking through with a tax professional, because the right move depends entirely on your own numbers. So those are the 7 mistakes. Claiming too early by accident. Not understanding your full retirement age. Triggering the earnings test while you work. Leaving spousal benefits unclaimed. Overlooking survivor and divorced spouse benefits. Never checking your earnings record. And ignoring the tax on your benefits. But before you go, I need to tell you the single most important thing in this entire video, so please do not skip these last 60 seconds. Social Security will not fix these for you. You have to take the first step. Not one of these things gets corrected automatically. No one from the government is going to call you up and gently mention that you claimed too early, or that there is an error in your earnings record, or that you qualified for a benefit on your former spouse all along. The money simply stays lost until you raise your hand, ask the question, and take the first step yourself. So here is your simple plan for this week. Step 1. Go to ssa.gov and create your free account, if you have not already. Step 2. Pull up your earnings record and check it, year by year, for errors. And Step 3. Look at your estimated benefit at every claiming age, so that when the time comes, you are making a decision on purpose, not by default. Write those 3 steps down on a sticky note right now, and put it somewhere you cannot miss it tomorrow morning. And if your situation is at all complicated, married, divorced, widowed, still working, or sitting on a mix of different retirement accounts, please do not try to guess your way through it alone. A good professional who truly understands Social Security can often find you far more than they cost. This is one of the biggest financial decisions of your life, and it deserves a real plan. You earned every dollar of this. Now make sure you actually get it. If this helped you, or if it might help a parent, a friend, or a neighbor who is about to claim Social Security without knowing any of this, please do me one small favor and share it with them. A single share could genuinely protect someone's entire retirement, and that is worth far more than any view count to me. Subscribe, because the next one could protect even more of your money.